Today's presentation is how to buy a $10 million apartment complex, multifamily financing. My name's Devin and my co-host here is Abel, and we will dive right into this.
All right. So nice to see everyone. Wanted to just hit on the vision for this multifamily meetup. We started about a year ago, and we wanted to create an area or a networking event here locally where we can work with other like-minded individuals that are all have the same goal to acquire multifamily commercial investment properties, really good investment vehicles, and have an opportunity to network with other individuals. Whether you're a passive investor, an active investor, we want to give that opportunity for us to come together, meet, and have the networking event. So with COVID, everything that's happening, we've done these live webinars. So we are meeting bi-weekly here on our webinars, but eventually we'll get back into meeting, shaking hands, saying hello, meeting other future partners. And it's just a great opportunity for all of us to get together. So we thought we'd continue sharing education, which is another big goal for us. A lot of people aren't sure how to invest in multifamily properties, or they know they want to, but they need to find the team, the right property, the right crew. So essentially it's an opportunity for us to kind of get together and, we again meet once a month is the goal in person eventually. And until then, we are definitely doing bi-weekly, one in the afternoon for lunch and one in the evenings as well. So we are the Apartment Educators, and we'll go to the next slide here. And really just so you know, our sponsor, Apartment Educators, coaching, education, and mentorship is super important in any undertaking, especially in acquiring commercial multifamily properties. So Apartment Educators is a team of successful individuals that have had a lot of success in this area, led by Devin and Ruben, and essentially creating an ecosystem for all of us that want to learn more, that are passionate about learning and getting some coaching, and all come together where the ecosystem is built in, so we can have a team that's doing deals in the best possible way, best possible format, provide some education, coaching. You'll see a picture of some of our students. If anybody has any questions from our sponsors, I think we'll hit on it at the end of the presentation. We are accepting applications right now. Every once in a while, we'll have an opening that is available for somebody that wants to learn more, wants to go do either actively or become a better passive investor. Is a great opportunity to learn more. So again, thank you very much to our sponsor, Apartment Educators. And we'll move on to our next slide here. Oh, also, if you have any questions throughout the presentation, on the bottom, you'll see a Q&A link. Please put the questions in as they come to your top of your mind. That way we can have a bank of them towards the end of the presentation. We'll definitely get every one of those answered. So please, as you go through the presentation, any questions you have, please raise your hand there or answer the question in the Q&A. And let's talk about the agenda. Devin?
Yeah, so we'll introduce Abel and myself in detail here in a minute, but we're going to talk about why multifamily. Many of you might be familiar with the reasons we love investing in apartments, but some of you might not. So we're going to cover that. Big part of today's presentation is multifamily financing and the nuts and bolts. The dollar amounts can be intimidating, but the mechanics of it, once you learn some of the nomenclature, is relatively straightforward. We're going to talk about terms to know, and then we're going to do a term sheet review, an actual, what do you get from a lender when they spell out the terms of a loan? And then as Abel alluded to, we're going to do Q&A at the end. So there's a Q&A box right now at the bottom of your screen. If something occurs to you anytime throughout the presentation, just type it in the box. We'll handle it all on the end. So a little bit about us. My name's Devin Elder. I was born and raised in San Antonio. I worked for two of San Antonio's largest employers after I graduated college, but I was really wanting a way to grow that the corporate structure wasn't allowing me to do. So I got into real estate investing, left my corporate job. Today, I'm a principal in almost 2,000 units, portfolio value over $130 million, and we continue to buy and sell multifamily deals in San Antonio. I am here because these are big deals and they typically necessitate putting a team together, right? So I'm here because the likelihood that somebody on this call ends up on a team for a deal I'm doing is high, or I end up on your team or as a passive investor in your deal in the future. All of this comes through networking and building relationships. So that's what I'm here to do. I also like to talk about this stuff and educate kind of the next generation of investors, but I also want to do more deals. I want to do deals with you. I want to be in your deals. I want you to be in our deals. And that all starts with relationships. So that's why I'm here.
And I'm Abel Pacheco. I'm the president of 5 Talents Commercial Real Estate. Some of my background from Corpus, 18 years, and San Antonio, the other half of my life. And I started in IT. I am a sales executive leader in the IT space for 13 years prior to real estate investing, and have had some successful runs in my IT career from 2010, $5 million in annual sales to $57 million in acquisitions in 2016. And so during that time, I've always been a real estate investor. As my full-time job, I realized the higher performance I had, the higher quota I ended up getting, and I never seemed to get out of this this rat race and figuring out how to get to retirement. Entered commercial real estate investing and went from 8 single-family properties to 800 doors. I'm a limited partner, a passive investor is how I got started in 400 doors, and I'm also an active partner in another, roughly 400 doors. So excited to give back. The reason I really enjoy doing these and creating the meetup and starting this was I was a beneficiary of education and coaching. So I've had some really great coaches, really great mentors, people that have helped me along the way. So I enjoy giving back. And then, as Devin mentioned, also I am also looking to go do more deals. So I am trying to create as much passive wealth, as much net worth, really create that opportunity for us to retire sooner, and spend more quality time with my family. So for all of this, we need partners. We need more individuals that are willing to invest, to see the same or have the same goals, in commercial real estate, maybe for their lives professionally or personally, and want to team up. So this is a great opportunity for us to provide education to those people that are interested, and then also find future partners. And thank you very much for joining. So we'll talk about the reason multifamily as we jump into it. We'll try to keep this brief, but for those of you that are new to multifamily commercial real estate, there's a few reasons. The big ones, if you have a full-time job, if you're a high net worth earner, if you have a significant capital event in a year, we want to create, or multifamily creates the opportunity to invest either as a passive, which we have a lot of passive investors, obtain some cash flow, build their net worth, have an opportunity to create additional equity in a commercial property, and have really great returns that are very stable, very solid, very reliable. And if the multifamily property is underwritten conservatively, which we all do, it's a great stable asset just to have, that's tangible, it's real, I can see it. I'm never going to see a stock go down to zero, and just create some really good returns for us. So some investors are passive and some investors are active in multifamily. The opportunity that we have as a multifamily investor allows people to maintain a full-time profession, a career, a day job. They make maybe a professional that makes a very good living. You realize that investing in single family, would take up a lot of time, have little return with little tax benefit. Multifamily is the exact opposite. It allows our investors to have a very significant return, a very solid asset that's going to create wealth over the long term without having to put a lot of time, effort, and energy into it, other than due diligence up front, maybe a little bit of education like you're doing now. That's what multifamily provides us. And then also, some of you are on the call, maybe interested in becoming active investors. Multifamily is just an amazing way to quickly turn your W-2 income into an active, really investing lifestyle, to go work other opportunities, syndicate, raise capital, and have other investors come along for the ride. We've been able to help a lot of family, friends, a lot of coworkers, a lot of people that we've worked with in the past just have the same success we do. You're never really going to get those same opportunities in single family. So that's why multifamily. And we'll go to our next slide, and I think I'll turn it over to Devin here.
So we're going to talk about how to buy a $10 million apartment complex, right? We're getting into kind of the meat of the presentation here and how this works. We're going to discuss why we use financing, the risks involved, the types of loans, and how you get approved for this kind of loan, right? It's a little bit different than going out and buying a house to live in with your family. So first of all, why do we use financing? Well, when we use leverage, we use other people's money, we're really going to improve the returns on a multifamily asset, right? If we go in and we buy a $10 million building without financing, first we need $10 million cash, and then we're probably going to get a 6% or so return on that cash, which, that might not be an acceptable return, 5 or 6%. And $10 million cash is a lot of cash to lock up in one deal. So it's rare that we see somebody go out and buy an apartment building like this cash, although it does happen. But when we use financing, we can leverage the bank's money, sometimes at 3.5% interest, 4% interest, and then we can have the income from the property pay that loan down over time. So we're getting near free money from the lender, and that really helps our return, because now instead of bringing $10 million to the deal, we might be bringing $3 million to the deal, and the rest is bank financing. And we're looking for the return on that $3 million that's easier to get higher returns on that smaller amount. We're also mitigating some of our risk by letting the lender be the majority capital partner in the deal, right? They're bringing 70, 75, sometimes as high as 80% of the purchase price to the deal. They're our biggest partner financially. Some of the risks of financing, well, you don't want to mess up your loan, or you don't want to stop making payments or do something that is spelled out in the loan agreements that make you in default of the loan, because then they're going to come take your property. Just like a single family house that you stop paying on. There are things that you might do as an operator to violate the loan agreement that could set you up for some real problems, right? But you clearly are going to set yourself up to avoid those things, but any investment comes with inherent risk. We want to be sure to call that out, right? So the risks of financing are violating something in the loan agreement or a loan maturity. Those are real risks, right? So if you've got a loan that's 5 years, that's due 5 years in the future, and you kind of forget about it and all of a sudden it's due in 6 months, you got to pay that loan off or they're going to take your property. So you don't want to be in that position. You want to be in a position, always be cognizant of where your loan maturity is. It's not like a single family house where your loan maturity is 30 years in the future. Now, we do usually get a 30-year amortization, meaning our payment is split up over 30 years, but we usually have a 5, 7, or 10-year payment. And that's just how it goes on these types of projects. Most of these projects trade or sell within kind of that 5-year window we see a lot of the time. Types of loans. I mean, we're going to talk about two high-level types of loans here. One is agency financing. This is financing that's backed by the federal government via Freddie Mac or Fannie Mae. There's some great advantages there and some drawbacks. And then we'll talk about bridge lending. And bridge lending is a shorter-term loan product for maybe a more distressed property. So, for example, we bought a property a couple of years ago that we're getting ready to sell now that was 70% occupied at the time we bought it. Well, we're not going to get that agency government-backed financing for that kind of occupancy. That's an inherently riskier property. Little side note, we are at 100% leased on that property today. Pretty cool. We literally don't have an apartment to rent. So the team's done an amazing job there. But when we bought it at 70%, we needed to get a bridge loan. This is a shorter term loan. You typically a little bit higher interest rate, and the bridge lender is going to be more familiar with loaning dollars to do those renovations. So if you're just starting out, bridge loans can be a little bit riskier, and they're predominantly riskier because of those shorter maturities. You don't want to get into a property, start doing your renovation, and you've got, a 3-year maturity. And we see people get into trouble a lot on those. As a buyer of multifamily, I see sellers getting into trouble with loan maturities. So you got to watch out for that. So those are some of the risks there on the bridge side, but bridge lending can be more flexible. I want to say that debt is like a loaded handgun, right? If you are foolish with it, it will absolutely kill you and kill people you love. It certainly has the power to do that, right? But if you get educated and you're responsible, it can be a tool, right? It could save your life. So think about debt like a loaded gun, in that absolutely you can get into trouble, but it's also a tool, right? And it's a tool that we use to build wealth in short periods of time, right? So that's the way to think about debt. Is it's a dangerous tool that needs education before you go out and use it, right? So the two types of loans, the agency stuff and the bridge. The agency stuff is typically lower rate, fixed rate, meaning that the interest rate doesn't change over time. And the agency stuff is good in a lot of ways. The part where it gets difficult is the exit costs. So if you're going to be in that loan for 10 years, you're good. But sometimes you got something called a yield maintenance, where you have this can be a multi-million-dollar prepayment cost. And, if you're going in to buy a large apartment building and you're planning on holding it for 10 years, well, that's great. But truth is, you might go in and improve the property, and you want to get out at year 2 or 3 and get investors their money and make money yourself, et cetera. And you might be locked into that deal because of in some cases, multi-million-dollar prepayment or a very large prepayment. So when you're looking at your profit at the end of the deal, looks great. We made millions of dollars, but then we got to make our prepay, and it completely destroys your return. So just something to be cognizant of. There are some options that help with that. One of them is called a step-down prepayment, where, the first 2 years you might have a higher prepayment percentage, but as the life of the loan goes on, it gets lower. And why are they doing that? The agency's setting that up because when they deploy this capital, they want to keep it deployed and yielding. Whereas the bridge lenders, typically you're seeing a 1% exit fee, sometimes no exit fee. It can be really easy to get out of those loans. The trade-off, though, is that you typically have a shorter maturity and a higher interest rate. So, I recommend, we're not loan brokers, right? We're operators. We go buy deals. But I recommend, especially if you're starting out, you build a relationship with a loan broker. And that's part of what we do in our apartment educators coaching program and community, is we put all the pieces together for our students to say, use this person and this person. This is who we use. But a loan broker can help you navigate all this stuff, right? We just want to paint the picture today of how this is done and how regular folks can form a team and go out and buy something like a $10 million apartment complex that for a lot of people just seems completely out of reach. It's doable by building a team, and one of those members on the team should be a loan broker to help you get through this. So now we're going to talk about approval requirements. At a very high level, what does it take to qualify for a $10 million loan? Well, credit score is typically not as important as some other loans. I mean, you might be looking at a 650 minimum credit score, 700 credit score. It's not that big a deal. What is a big deal is cash, net worth, and experience. You got to have those things. So if we're looking at a $10 million building and we get a 70% loan to value, we're looking at a $7 million loan. If the lender's saying, hey, we're going to give you $7 million, we're going to be in a first lien position, they're going to want some other things. They're going to want net worth of the principal team equal to $7 million. If the loan's $7 million, they need your net worth to be $7 million. Now, if you're going out and buying an apartment complex by yourself, you need to have a $7 million net worth. If you're building a team, the management team or the GP or the sponsors, we use those terms kind of interchangeably, that team needs to have net worth of $7 million. So it's not uncommon to have one guy on the team that just has a big net worth and maybe he's not doing much else, right? That's not uncommon. Maybe he's got a big net worth and a lot of liquidity, and it can help get the team get it done. Also, if you've been doing a few deals for a few years in multifamily, it's not inconceivable to start building up large amounts of net worth and liquidity through apartment investing. So once you get in the game and you start buying these things, the net worth starts to stack up relatively quickly. The other thing is the cash component. So they usually want to see, a rough rule of thumb is 10% of the loan amount in cash. So if we're doing that $7 million loan example, the lender's probably going to want to see about $700,000 cash in the bank, not in the project. So you might raise $3 million for the project. They want to see that separate, that the principals have that. And again, that's combined among the sponsor team. It doesn't necessarily just have to be one person. So they're also going to want to see experience. They're not going to give you a $7 million loan with no experience. So you've got to have balance sheet or net worth, liquidity, and experience. And again, a lot of ways this is accomplished for somebody that's starting out is with a co-GP or a partnership where you've got somebody with more experience that can help qualify for the loan. So those are at a high level the approval requirements that it takes to get into this type of loan.
Yeah, and Devin, on that point, right? So you've kind of talked about the technical details that are absolutely needed in this space. For anybody that's new, they're trying to get into their first deal, and you're looking at this number saying, well, how am I ever going to find someone with $7 million of net worth or $10 million of net worth, or how am I going to find that much liquidity? Devin said it a few times, but I don't want to gloss over it. Part of it is just the mindset, your paradigm shift has to be in that perspective of confidence that if you find the right deal, you can absolutely put a team together and make the deal work. You will find a key principal. You will find general partners. You will find investors, because when the deal is good enough and it makes everybody money, you can absolutely go find a team. And there's fast tracks to get that done more quickly. And we talk about coaching and education and ecosystem. Part of what we're trying to do is this exactly. And if you're a high net worth individual and you have $7 million of, personal net worth today, but you don't know the other components, that's a great time to reach out and say, hey, this is what I have and this is what I want to go do. Vice versa, if you're a high earner but have little net worth and you're like, well, I have some money and I want to invest, but I need a team to do it. That coming together is exactly what we've created kind of this, this meetup for. Is these are the technical components that Devin's talking about. And now let's come together as a team and go do it. And we have a lot of these components today, but obviously you're maybe in different markets, you may be in different area, and everybody's in a different scale. But if you have the right paradigm that it's possible, you can go do it. You can go do it.
Yeah, good point. A lot of this is paradigm shifting, right? But one of the things that was helpful for me kind of growing up in this business was understanding that a lot of people have a problem of what to do with their money. Earlier in life, your problem is, how do I get money? Later in life, your problem is, how do I deploy this money, right? If you're sitting on a couple of $1 million to deploy, that is an important challenge. Do you put it in the stock market? Do you try to find somebody you trust to invest with? So we're literally trying to solve problems for those people that have the problem of where to put their capital. So some important terms here that I'm going to cover and dive into detail on. And they're all spelled out here for you. So I'm just going to go through these one by one. The first one is debt service coverage ratio, DSCR. This means how much of the income of the property is going to that bank payment. If the bank payment is 20 grand a month and the property makes 20 grand a month, well, that means you've got a debt service cover ratio of 1. That's not going to look good, right? If you owe the bank 20 grand a month and that's all that's left over after operations, you got a 1 ratio. That's not good. If the bank payment is 20 grand a month and the property throws off 40 grand a month after operations, Well, now you've got a debt service coverage ratio of 2, right? That's really good because you can pay the bank and still have all that money left over. The bank is typically looking for 1.25, maybe 1.35, something along those lines, right? So that's what a debt service coverage ratio is. They want to make sure you can pay all the operations and pay the bank and then whatever's left over, right? Next term here is interest only. So if you've got a mortgage on your house and you pay $1,500 a month on your mortgage payment, well, some component of that, you basically have 4 components of it, right? PITI, principal, interest, taxes, and insurance. So PITI, principal, interest, taxes, insurance. That makes up your $1,500 house payment, right? Well, it's the same on apartment complexes, but in some cases, you're always, you've got your interest payments, you're making that, taxes and insurance, you're paying that. But that first one, principal, there are cases where you might not have to make the principal payment. So instead of your payment being $35,000 a month with paying the principal down, it might be $20,000 a month. And what happens with your loan balance? You're not paying your loan balance down. So if you have interest only for the first year, your loan balance is $7 million on the first day, and it's still $7 million a year later. You did not pay the loan down. But what you did do was you freed up 15 grand a month in cash flow off that property. And so we see sometimes 1, 2, 3, I was seeing 5 years of interest only on deals. Typically it's not that high. 1 to 3 is more common. 1 to 3% interest rate, right? I'm sorry, 1 to 3%, 1 to 3 years of interest only, excuse me. So what that does, it just creates more cash flow for the property. This is especially useful if you are going in and making a lot of improvements year one, where boy, you sure could use that extra cash, right? And in some cases, I talked about bridge loans earlier. You might be in a deal for 2 years. You may never pay the principal down. You might get into that deal, do your improvements, create more value and sell it. And the loan balance just stays the same. What that does is it lets you keep more cash. So it's a double-edged sword, right? It helps your cash flow. But if you're holding it long-term and you're paying the note down, that's creating more wealth for everybody in the deal too, right? So just something to be aware of there. Certainly if you put interest only in your underwriting model, it's going to help investor returns, right?
And Devin, this was a paradigm shift for me too, because the first time I heard it, I go, well, we're not paying principal down. As a former 10-year single family investor, I always wanted principal pay down. That was how I was making some equity. And then once you realize cash flow, we can create cash flow and improve the value of the property. So you're saying you bought it at 7 and now it's worth, 10 or whatever the amount. That's also some of the equity that you've created. So the cash flow is what we're investing. If you've never done a deal like this, we're trying to get as much cash flow for all of our investors at the same time. So that's great.
Yeah, that's right. And the name of the game in all of this is, what is the net investor return? Now, if you got $10 million, you're just going out and buying this on your own, that's great. It's a little different. But for those of us that are putting a team together and putting investors together, all this stuff comes down to what is the net investor return. And when you put in interest only, it's going to help your net investor return, right? So we'll move on to non-recourse. This is a big reason that we invest in apartments, right? So I've got some single family rental houses. And if I've got a loan on those and something goes wrong, Devin Elder's personally liable for that loan, right? So there's some risk there. On these bigger apartment deals, all the ones we're doing are non-recourse, meaning that, at least in theory, the bank cannot go after the principals personally if the deal goes sideways. What they do is they come take the property if everything fails, right? So in theory, the principals are not on the hook for the loan balance, right? Which is huge. It's how people can have $100 million in loans on these properties, because it's asset-based lending for the most part. A lot of what the lender's looking at is based on the asset itself. Yes, they're looking at the borrowers, but they really are collateralizing the loan primarily by the asset, right? So non-recourse means that the principals are not personally liable. Now, you can do some things to trigger what are typically called carve-outs, right? Hey, if you do this, this, or this, if you're criminally negligent, if you file an insurance claim and you pocket the proceeds, right? You do some real dumb stuff, then you can trigger a non-recourse loan into recourse, right? That can happen. But in general, when you're starting out, you're getting these loans, non-recourse is a lot better than full recourse. Next, we'll talk about agency and bridge. And I did talk about these earlier, but agency is typically lower rate, fixed rate, backed by the government, Freddie Mac or Fannie Mae, and can be a fantastic loan product. They may have a few more requirements around the property in terms of things that required repairs and things. And then, of course, the big gotcha is the prepayment. Exit fees are sometimes really brutal on the agency stuff. So if you're going to hold it long-term, that's okay. But if you want to understand what it's going to cost you to get out at year 2 or 3, if you have a buyer come knocking, right? Because you need to have that flexibility and you need to understand the implications for your investors there. The bridge loan I mentioned is typically a little bit higher interest rate and a shorter maturity, but can often result in higher proceeds, meaning more money to you. They're more comfortable with distressed deals, with occupancy problems and things like that. Now, just because a deal is a junker, well, let me rephrase. Just because an asset is a junker doesn't mean it's a deal, right? Just because it's messed up doesn't mean it's going to make great money. Sometimes clean deals make great money too, right? So there's not a direct correlation there. But anything at the right price makes sense. And sometimes a bridge loan is the right move. Now, not recommended for the novice, right? Really, ideally, your first deal that you do is going to be stabilized, meaning it's 90% occupied or better for the last 3 months at least. And you go into an agency loan, right? But bridge is a tool. Again, debt's a tool. It's a loaded gun. You got to know what you're doing. You got to go take your gun safety and training classes before you get out there and start using it. But if you do that stuff, it is a fantastic tool for building a lot of wealth in a short period of time, right?
Hey, let me touch on that part. When you said the bridge loan is not for the novice, it's not for the first time deal investor. I'll caveat that though and say if you're a passive investor, a limited partner in someone else's deal, they have track record, they have experience, and they've taken apartment complexes that are highly distressed, turned them over, had a great success doing so. My first deal as a passive investor was in a bridge loan, a non-stabilized product, and that. Now it's a little less than 2 years. Actually, one of the deals Devin was mentioning, like I'm a limited partner passive investor, and man, that was a quick turnaround. It was exactly this. So that is a way to kind of leverage that. Getting in with an experienced team, they've used it before. Just because you've never done a deal doesn't mean you can be a limited partner or passive investor in it and make a great return and do it quickly. So I think that's awesome.
Yeah, great point. So a lot of these points I'm making are kind of from the operator perspective if you're running it. But as a passive investor, that's the beauty of it. You can find a team that is experienced and leverage their experience and passively invest with them without having to mess with any of this stuff. And yeah, that's a great point. So I like bridge for the right deal. You just have to be aware of the risks and be well positioned to mitigate them. So key principle, this term gets thrown around often as KP. One of the things I like to say to our apartment educators, students sometimes is, learning the acronyms in anything is like a shortcut to seeming like you know what you're talking about, right? So you start learning terms like DSCR and KP, and you start talking to people at some of our meetups and stuff. It's going to make you sound like you know what you're doing, right? So it might be worthwhile to go learn what a KP is or what above the line, below the line, DSCR, NOI, IO, all that stuff. Because just like any job you start, there's its own set of acronyms, and we certainly have those here. So what's a KP? Typically a KP, in the way we use it, is somebody that's got that net worth and liquidity that's going to get the deal done, right? So in a fictitious example, Bob and Joe want to do a deal on a $5 million loan. Well, they need $5 million in net worth. Well, Bob's going to go run it. He's going to do the work and he's going to run the deal every day. Well, Bob's net worth is $1 million, so he's not going to qualify for that loan. But Joe's net worth is $6 million. Together, they have net worth of $7 million. So Joe's going to be the KP. He might not do a lot of the work, but he's going to be on the deal and he's going to own a percentage of the deal, right? for being that KP, while Bob's going to go out and do the work because he didn't have the net worth and the liquidity to do it. So it's very common, especially on these larger loans, to have a KP. So you might say, who's your KP? Or, because to get $5 million loan, you need $5 million in net worth, right? And so you might have to bring in a KP to satisfy that requirement. So that's what we call that person.
Hey, Devin, I mean, for the active investors that want to go do their first deal, how would you recommend they find a KP, their first couple deals, their first, give them a tip here, give them a nugget.
Well, it's tricky because somebody that's got, let's say, that $5-6 million net worth, a lot of times they didn't get it by accident, right? They got it through shrewd business decisions. They got it through, a fortunate work situation, through being a business owner. Somebody that's got that kind of net worth is no slouch, and they're not just going to sign on stuff left and right. So it's certainly a relationship-based deal, and getting in a group of like-minded folks helps shortcut a lot of that. If you're out there just kind of talking to people, maybe your neighbor or something about, hey, you want to sign on this giant loan? I mean, that sounds horrifying, right? If you don't have the context. But if you get in a group of like-minded people that, hey, we want to go buy apartment complexes, well, being a KP is attractive to somebody that's higher net worth because they're going to get ownership in a deal that is not requiring them to do a lot of work. So if I'm a surgeon or a dentist and I have a high net worth, well, I don't have time to go run the deal. But if I met Abel in an event and we hit it off, we've gotten to know each other, we feel good about doing a deal together, and we've built a relationship, number one, then maybe I want to be Abel's key principal because that's a way for me to participate in this big deal and get equity and cash flow and ownership without having to be the guy that's out there running the deal. So it's attractive for a higher net worth person to be a key principal. They can also scale that. They can be key principal on multiple deals, right? So to answer your question, Abel, it all starts with relationship. Being in a group of like-minded folks helps shortcut that rather than walking up to strangers cold or people in your network that don't have any frame of reference for apartment investing. That might sound crazy to sign on a deal, but people that have gotten some education and are actively pursuing being apartment investors are going to understand the role of the KP, and that's a much better place to meet a key principal in some kind of like-minded environment. So we'll move on to the fixed rate. I've alluded to this twice so far, but a lot of times with these agency loans, you get a fixed rate. It's a 4% interest rate, and it's going to be 4% for the life of the deal. Not going to change. That's good, right? We want a fixed rate. Assuming you have a low rate, sometimes you get stuck with a fixed rate that's higher, and that's not great. But at the time you close the deal, you do the best you can. The opposite of fixed rate is a floating rate. So this might be a rate that changes with the LIBOR and changes on a monthly basis, right? So that can be good and bad. You might get a rate that's low, but there's risk in the future of it going up if interest rates rise. What you could do is purchase a rate cap in that scenario. And that is a insurance policy that says your rate is not going to spike if interest rates spike. So you can typically buy a rate cap for, we've seen it $20,000, $30,000 range on some deals, which, hey, that's a lot of money, but not on a $10 million deal, right? That can be absorbed in a $10 million deal. So just some things to be aware of. If you have a floating rate, then your monthly payment might be variable, right? Based on what happens with the rate. I'll jump now into prepayment penalty. So this is I've talked about this actually several times. This is something you have to be aware of. What's it going to cost to get out of this deal? You might have a loan with good rate, fixed, you like the loan, but what's it going to cost you to exit? And you want to make sure that you model that financially to understand that it doesn't completely kill all the returns, right? Again, bridge product is usually a little more forgiving. Usually, you've got a 1% exit fee or sometimes no exit fee. That's easy to get out of. The trade-off is a higher interest rate and a shorter loan maturity. The agency stuff can be very expensive to get out of. Now, there's options around that, but you just want to understand what that prepayment penalty is going in. And the last component we'll talk about is COVID escrow. This is something hopefully in the next couple of months that we don't have to talk about anymore. But right now we do. We're recording this in mid-June of 2020. And we just got, this whole COVID pandemic, global pandemic, and just unprecedented shutdown of employment. It's crazy. The lenders are saying, hey, you borrower, we need to see a year of payments to us. We need that. We're going to go ahead and take that up front. You go ahead and give that to us in case something happens. We need to make sure that first year we're covered. So on a $10 million deal, that might be $400,000 of extra money you need to escrow with the lender, right? And we'll talk about that here in subsequent slides. But that's what buyers and sellers are contending with right now in summer 2020 is this additional escrow. And there's some creative ways we're working around getting around that. One of the creative ways is have the seller work out some kind of a credit to handle the escrow. Or you take $400,000 of capital improvement plans and just plan that for later after you're able to get that money back, because you should be able to get it back within 9 to 12 months. And this is changing on a daily basis. I'll make another kind of pitch here for working with a loan broker, especially if you're an operator starting out, and a loan broker can help guide you through all this stuff. But that is a component of today's lending landscape, is that COVID escrow. And it could be significant, right? Coming up with an additional $400,000 is no joke on a deal. All right, so we can jump ahead here. We're going to look at the actual term sheet from a lender, right? So it's called a term sheet because it spells out the terms of the loan. This is not a commitment from the lender. This is just guidance. And this is, you haven't signed an application or anything, but this is, if you're going to look at a deal, you can go right to the lender and say, hey, we're looking at this deal. Can you get me a term sheet? They're going to ask for financials on the property, and then they're going to show you something here with some terms. So we got a loan amount of $7.5 million. Structure 10-year fixed means that this loan is due in 10 years, payable in full in 10 years. But it's amortized over 30 years, just like your mortgage might be on your home, right? If you own a house, you're making that loan is spread out over 30 years, right? 360 payments, is that right? No, maybe not. A lot more than that. But it's over 30 years, but it's due in 10 years, right? So that's what 10-year fixed means. Prepayment yield maintenance, that means you owe all of the yield on that loan when you sell it. That's extremely high. We're going to talk about some ways to mitigate that. If we sell in 10 years, great. But if we sell in 2 years and we owe the rest of the loan profits to the bank, that's going to be tough. Rates 3.54 is pretty good in today's environment. This interest rate is not locked until a loan commitment is issued and accepted. The application rate will be held for 35 business days for due diligence prior to lock. So there's this term rate lock, and that means you're locking in whatever rate. So expect the rate to bounce around a little bit until you rate lock. And this can have material impacts on, well, not material, but it can have big impacts on your underwriting of the deal. Okay, so we'll move on here. And let's look at the provisions of the loan here, right? Maximum loan to value is 80. So 80%. So that means if we had a $10 million loan, $10 million purchase, they could loan up to $8 million. DSCR, we talked about this, debt service coverage ratio. If the mortgage, just for round numbers, is $10,000, or if the bank payment's $10,000 a month, this property needs to generate $1,250 a month to cover that minimum. You want more than that, but that's the minimum. Recourse, we talked about non-recourse earlier, and this means they say none. This is non-recourse besides industry standard carve-outs. And a carve-out means things like, sometimes called bad boy carve-outs. It might mean if you're fraudulent, if you neglect to have an insurance policy on the property, if you misuse insurance proceeds. There's some things like that that can make this convert to a recourse loan. Prepayment alternatives. This is something I really want to address with you guys. Because for an additional, remember our rate was 3.54? Well, if we could make the rate 3.74 for an additional 20 basis points and get this prepayment alternative. So rather than having to pay yield maintenance and pay the rest of the profit of the loan when we exit, we can have this step down, right? So in the first year, we owe 5%. Second year, we owe 5% of the loan. Year 3, we'd owe 4% of the loan, and so on down to the end. Or we can be even more aggressive with it for an additional 35 basis points, and we could step it down like that. So this is, my estimation, if you're going to entertain me selling it year 2 or 3, you probably want to buy this because it's going to be a cheaper exit cost. Deposits, $8,500. This is really a low deposit. Sometimes these deposits are $10,000, $20,000, $30,000, but this is very low in this case. Rate lock deposit, 1% at loan commitment, and they give it back to you at closing. So if you're the operator, you're going to have to come up with this stuff out of pocket. This is a Freddie Mac loan. So this is an agency loan, and there's an application fee of 0.1% there. And then the escrow, they're going to want to see taxes, insurance, and replacement reserves, plus 12 months of principal and interest for COVID. I talked about that earlier. So we can dive into the COVID terms now on the next sheet. And this is just specific to what's happening. Well, this is at the end. We'll talk about COVID at the end. Third-party reports. This is just the appraisal and the physical inspection that the lender's going to do. Assumption rights means that somebody else can go in and take over this loan, assuming they're qualified, and they pay a 1% fee. They could take over this loan. I don't really like assumptions. I don't see them get done a lot, but it is one more alternative, because if somebody comes in and assumes your loan, well, now you don't have to pay that prepayment. But you're trying to buy it here, create value. So if your loan is here and you create a bunch of value, nobody's going to want to buy it at your loan, right? So you might be able to put a supplemental on there, and that's a separate thing. But in general, I don't see assumptions happen a lot. It's usually new debt that's getting put on the project. So sponsor financial requirements, we covered this. Net worth equal to the loan amount. Minimum FICO score 650. Here's some other closing costs: the appraisal, the risk report, legal, miscellaneous. And then Freddie Mac's got to review this. We could jump now to the next page for COVID. And I'm not going to read all this to you, but basically the lender's wanting to see that there's no like shelter in place restrictions for a period of days, because they're just covering their asset, right? So the COVID restriction is basically saying, we're going to give you this money. We're going to give the bank money. They're just going to hang on to it. And after we meet this, after all federal, state, and local emergency declarations are lifted for at least 90 days, we can get the money back, right? So this is rapidly evolving. You know, if you're watching, recording this sometime later in 2020 or beyond, hopefully this has gone away, but it is an issue we're having to contend with now. So I think we can kind of jump to Q&A. We've only got a few more minutes left on the webinar here. We've got a question: will this webinar be added to the free webinars on the website? I don't know, but one of my colleagues can jump in on that. Are agency loans transferable? Yes, good question. They are. Assumable is the word, right? So we just went over that term sheet. Somebody can assume it. But let's say you buy a property for $10 million and you get a $7 million loan. Well, through operations and value add, you make it worth $14 million. Well, nobody's going to want your $7 million loan on a $14 million project. This is 50% loan to value. It could happen, but that's going to be tough to swallow for a lot of buyers, right? Next question: can a KP do multiple deals using the same net worth without compromising any deal? Yes. Isn't that crazy? They can. You can be a KP on multiple deals. That's the bank's rules. That's how it's set up. I didn't make those rules, but yes, you can be a KP on multiple deals. And that's one of the attractive things about being a key principal, right? Is you can get that, right? So we've got some feedback on the webinar. It will be recorded and available in our website under the webinar section. We'll also send out a follow-up with this. So if we have any other questions, we can take those now. Otherwise, we can wrap up. I want to thank everyone for joining. To learn more, you can go to apartmenteducators.com. And I think we'll keep it open for questions until the very end here, but we want to talk about our next event too. The next event we have here, I think we can throw it up on the screen, is coming up soon. And
while we're waiting for the slide, it's on July the 1st.
Perfect.
At 12 p.m. So we're going to be discussing building a brand for your multifamily business.
Yes.
So that should be a good topic for some of you guys that want to go do more of these deals, or wanted to do maybe your first or more, and you're trying to figure out how in the world do I get some presence out there I think we've all heard that you work with people, you invest with people, you do business with others that you know, like, and trust. But if they don't know who you are, they're never going to like you or trust you. So you got to get that brand out there so that people know who you are. Then they can determine if they like and trust you. So we'll be talking about that on July the 1st.
Yep. You can also register at apartmenteducators.com/events. We'd love to see you at the next one. We will be doing live events at some point in the future. Can't wait to get out and shake hands. And go ahead and throw a like on Facebook so you see what events are coming up. Thank you guys so much for joining. Can't wait to see you in person before too long. Thanks so much. Have a great afternoon, guys.
Thank you, everyone. Bye-bye.